Hi, everyone. Mark Lichtenfeld, Chief Income Strategist with the Oxford Club. This is State of the Market. Markets are out of control again. They're getting very volatile once again. We're seeing markets that open up 700 points, then dropping 900 points and rebounding 700 points, all within one trading session. The markets are just crazy go nuts. They're insane. So today, as an investor, you need to be thinking about safety. Now, it's natural. People want to talk about stocks all the time, right? Because they're fun. Stocks like Tesla are sexy, right? That's my little sexy shimmy right there. But it's fun. And when a stock like Tesla quadruples in less than a year, if you own a stock like that, you have a good time bragging to your friends about your big winners. And, stocks are really easy to trade. It's just, basically one click on your brokerage account and it's free and it's so simple. But nobody really talks about bonds, right? Bonds are for your grandmother. You clip the coupon, you wait for the bonds to mature, you get paid interest twice a year. And, well, as the president would say, wrong. Here's why you should be thinking about bonds for your portfolio. One word: safety. When you buy a stock, it can obviously go up, it can go down, and at some point you'll sell it, and hopefully that stock price is higher than where you bought it. And if you hold it for the long term, there is a good chance that will be the case, but not always. When you buy a bond, however, you are contractually guaranteed to get $1,000 per bond at maturity. So if you paid $1,000 for the bond, you get your money back, along with all the interest that you've collected along the way. But if you paid $900 for the bond, you get $1,000 back at maturity. So you make a $100 profit in addition to the interest. Now, a bond is a loan to a company. So if the company wants to keep the lights on and stay in business, it has to pay back its bondholders the full amount of $1,000 per bond. So if they don't, they go into bankruptcy. Now, it happens, but it's pretty rare. For example, investment grade bonds, which are the safest corporate bonds, those bonds default at a rate of 0.18%. So almost never. The higher risk speculative bonds, the high yielding bonds, sometimes known as junk bonds, their default rate varies between 2 and 4%. So even when you buy the riskiest bonds, the overwhelming majority of them pay back their bondholders at maturity. So how do you get into bonds? Well, most investors buy bond funds or ETFs. And I'm telling you, don't do that. You should buy individual bonds. Here's why. Owning a bond fund is a near guarantee that you're going to lose money over the long term. Here's why. First of all funds and ETFs are not charities, right? They charge fees that come out of your returns every year. And you really can't afford to be giving up 1% or even 0.5% of your assets if you're only earning, let's say, 2.5%, 3%, even 3.5% a year in a bond fund or ETF. But most importantly, interest rates are near zero. And when rates eventually rise, bond prices fall. And if bond prices fall, the value of the portfolio of the ETF or fund will be lower. And when you go to sell it, you will lose money. But wait a second. If bond prices fall, why would you own individual bonds? Well, this is where the safety comes in. Remember, the company is contractually obligated to pay you $1,000 at maturity, regardless of anything else happening in the world. There could be a pandemic, there could be wars, their stock could be in the toilet, higher interest rates, you name it, anything could happen. But if the company wants to stay in business, it has to pay its creditors, which include you. Now, a bond price could fall while you own it, but if you're planning on holding it till maturity, which should be your plan, then who cares where the bond price is at any given time? For example, let's say you buy a bond for $900 and it matures in 2024. Well, next year, the company runs into some difficulties and the bond price falls to $800. That doesn't matter because at maturity, your bond will pay you back $1,000, regardless of where it was trading any time in the past. So let's say you're investing for something very specific in a specific time frame, like you're going to retire in 4 years or you're going to have college tuition to pay for. If you buy a stock, price could be higher, or if we hit a nasty bear market like we just experienced, your stock holdings could be lower by 30%. If you buy a bond in 4 years, you're going to get your $1,000 back again, regardless of where the bond was trading any time before that, and you'll have collected interest along the way. If the company stays in business, it's going to pay you your $1,000 back at maturity. So while I do love dividend stocks for their ability to grow income and compound wealth, when it comes to safety, bonds are actually safer, especially in the short term, and they're worth a very serious look. Now, next week, I'm going to talk about how to buy a bond and what you need to know in order to do so. So if you have any questions about bonds, leave them in the comments section. And don't forget to sign up for my free newsletter, Wealthy Retirement, by clicking on the link. Every week, we go into wealth building strategies and discussions on stocks and bonds and everything you need to know about growing your wealth. So until next week, I'm Mark Lichtenfeld. Thanks for watching.